Paying tax. There are many different types of tax that are payable by a business. In this short video, we will present a brief overview of each of these different types of tax. Some taxes are payable to the federal government, some are payable to the state government, and some are payable to the local government. Taxes payable to the federal government include income tax, fringe benefits tax, capital gains tax, goods and services tax, and excise duty. Taxes payable to the state government include payroll tax, land tax, and stamp duty, and a type of tax payable to the local government is rates. Income tax is a federal tax levied on the taxable income of a person or business in a given year. Corporations pay income tax at a flat rate, presently 30%. Income tax payable by individuals, which includes sole traders and partners, is calculated using a sliding scale. This sliding scale is set out in the table on the left of the screen. Who pays more tax? Sole traders, partners, or companies? The answer is that it depends on the amount of income. How much tax is payable by an individual, a sole trader or a partner, who earned a taxable income of $50,000 in the year 2014 to 2015? If we look at the table on the left, we can see that we start with the amount of $3,572, and then we work out the difference between $37,000 and the amount of income, $50,000, and multiply that by 32.5%. Adding that to the $3,572, we end up with $7,797. This is the amount of tax that will be paid by a sole trader or a partner on income of $50,000. However, if the business structure was a company, then tax would be paid at 30%, and 30% of $50,000 is $15,000, so a company would pay more tax than a sole trader or a partner. But what if the income was $5 million? Then if the business structure was a sole trader or a partnership, the amount of tax payable would be $54,547 plus 45% of the difference between $5 million and $180,000. The amount of tax payable would be $2,223,547. However, if the business structure was a company, then again tax would be payable at a flat 30%, which would be $1.5 million. The company would pay considerably less tax. We can see now that the reason why many businesses choose to incorporate is because by incorporating they will pay less tax. And the reason why many businesses do not start out as a corporation is because there is less tax payable by individuals, sole traders, and partnerships. If a business has employees, it is obliged to withhold income tax from the payments that it makes to them under the pay-as-you-go withholding scheme. At the end of each financial year, each employee completes a tax return setting out their actual income, and any difference between the total amount withheld and the employee's actual tax liability is paid by the employee or refunded by the Australian Taxation Office. GST, or Goods and Services Tax, is a federal tax of 10% on the sale of most goods and services. GST is collected by each supplier in the supply chain who is registered for GST. Each supplier will usually charge the 10% GST to the person to whom they supply the product, and then pass on the GST that they collect to the Australian Taxation Office each month, or quarterly, or annually. However, they are entitled to deduct from this amount any GST that they have paid to the person who supplied products to them. Fringe benefits tax is a federal tax calculated on the basis of the taxable value of the fringe benefit paid to an employee. So an employer who provides additional benefits to employees, such as paying for their car or accommodation, is obliged to pay tax on that fringe benefit. Otherwise, the provision of fringe benefits could be a way for employers and employees to avoid the payment of income tax. Capital gains tax is a federal tax payable on any gain a taxpayer makes when they sell an asset such as real property or shares. Excise duty is a federal tax payable on the sale of certain products such as alcohol, petrol, tobacco, and coal produced or manufactured in Australia. Payroll tax is a state tax payable on the wages paid to employees. Land tax is a state tax payable annually and calculated on the basis of the unimproved value of the real property of which the taxpayer is the owner. Land tax is not payable in relation to real property that the taxpayer occupies as their principal place of residence. Stamp duty is a state tax paid upon certain transactions, such as the sale of real property or motor vehicles, and is calculated on the basis of the value of the transaction. And finally, rates is a tax payable to the local authority, calculated on the basis of the unimproved value of land owned by the taxpayer, and applied to fund the provision of basic services to that land. Unlike land tax, rates is payable in relation to real property that is occupied as the principal place of residence.